Let's now turn our attention to the fiscal math around it, right? So, in terms of the budget, the government of India had estimated a gross tax revenue of 24.6 lakh crore, out of which 7.66 lakh crore was going to come in the form of corporation tax, corporate taxes, right? Now, the corporate tax numbers are they were anyway expected to be a little bit bullish than what they were probably coming on ground, because the economy was kind of showing signs of slowing down. The government also said that this entire thing will result in 1.45 lakh crore loss to the government essentially, and that's being passed on to the economy. So multiplier effect aside, what's the immediate impact in terms of the short-term fiscal scenario? So if you look at the total tax revenue estimate of corporation tax that's given here, and given that there is going to be an impact of, so if you work this down in terms of the overall understanding, there is a government borrowing number which is the same as the fiscal deficit number. Whatever is the deficit, which is the difference between your earnings and your expenditure, is going to be borrowed, and that difference is now going to increase by another 1.45 lakh crore. On earlier estimates, the government had suggested that fiscal deficit as a percentage of GDP will be 3.3%. There was definitely a shortfall, because even after the RBI dividend, the government did not come and reduce the fiscal deficit target. They said that it's going to remain at 3.3. Now, if we assume that this entire 1.45 lakh crore is not going to get recovered, then the immediate term impact is that the government's fiscal number is going to get spiked up by 1.45 lakh crore fiscal deficit number, and that would take fiscal deficit as a percentage of GDP to 4%. Impact: fiscal deficit goes up. Fiscal deficit goes up would result in government borrowings that need to go up. Government borrowings that need to go up would essentially mean that government bond yields and consequently interest rates in the economy are also likely to go up. Now, that's not too much of an issue, because monetary wise we are trying to kind of cut it down, but in the immediate aftermath globally, the attractiveness of Indian bonds is going to reduce a little bit, because global investors don't like very high fiscal deficits that are run by governments, right? So that's the issue with the fiscal math immediately. In addition, given the slowdown that's happening, it's likely that income tax is also going to be slightly lower. And so if these collections are lower and market conditions are not good, disinvestment proceeds are under stress, then the government might have to kind of reduce its earnings, reduce its expenditure in order to keep fiscal deficit in control. And that brings us back to the same equation, G plus C plus I plus X minus M. The government may have to control its expenditure, given that earnings are now going to be lower. The government has essentially passed on the burden of those investments to businesses. That's the best way to do it, to be honest. The question we need to ask is if these businesses are really going to use this money in the short run. Long run, undoubtedly, this is a positive move. But in the immediate term, would a business that is running at 70% capacity utilization, let's say today, argument's sake, a steel company is running at 70% capacity utilization, why would you put up more capacity unless the existing capacity gets used, right? So a lot of the businesses like cement, steel, auto are reeling under demand issues, and unless the demand picks up, which takes a little bit of a while, because we probably have sold a lot of stuff in the last few years on credit. Companies have taken debt and kind of expanded capacity more than what was needed. People have taken debt and gone and bought homes and cars and consumer durables. So it's quite possible that we see a couple of years of sort of structural, slowing of the broad demand in the economy. And unless that is revived, it remains to be seen how much of this gets used by the companies.